analysis. We're going to take a look at those popular companies, break them down on a fundamental basis, just see if there's an opportunity here to buy. Maybe you should sell it, or maybe it's a hold. That's what we're here for, to look at it again with our fundamental opinion. With that said, if you find this video informative, be sure to hit that subscribe button below so you're informed about our future videos. But today, gosh, I feel like we had a wide variety of stocks to look at. There's been so much going on. We did do some Facebook posts though on Amazon and Meta/Facebook. One that we didn't hit, and I figured it'd be a great opportunity, is PayPal. That's another one that took, gosh, just a shellacking, I'm going to say, earlier this week. Not a good fintech performer in the past week that we saw.
And Chase, this is what happens with growth companies, why we've been so concerned about them, because growth companies are doing fine when the growth is there, but you have a little bit of disturbance in that growth, a little pullback on that growth. Oh my gosh, you can see major declines of 10, 50, maybe 20% in one day. And then don't think that could be a buying opportunity, because it may not be, because there could be more to come, or perhaps flatness for years to come as the earnings catch up to those high valuation ratios.
Yeah, and when you look at this stock today on the fundamentals, what you're going to see is they reported this week, but the numbers will kind of tell you a little bit of a story of why we believe the stock got hit so hard. You'll kind of see why we avoid stocks like PayPal. And one thing that we talk about is those growth stocks. The reason we avoid them, I'm going to tell you right now, PayPal closed down 24% on Wednesday alone. Well, if you look at the headline numbers here, not that bad. I mean, they missed earnings per share in Q4. It was $1.11. Well, the expectation was $1.12. Well, that's not bad. Not bad enough to send it down 24%. They beat on revenue. But the problem is with these high growth stocks, as I said, with high valuation stocks, is their guidance. Their forward guidance for the first quarter was earnings per share of 87 cents. Analysts were looking for $1.16. Also was looking for a growth rate from the analysts about 17.9% in 2022. Well, PayPal came out and said they're looking to grow about 15 to 17%. That's still not a bad growth rate. But the problem is the analysts say, we were looking for this. We were pricing for perfection. Now they're not getting that. Now you see a huge disturbance in the stock price.
And not to say that's going to happen, but perhaps some of these high growth companies down the road could be value companies where we buy companies when we pay 10, 12 times forward earnings. That can happen. At one time I owned Microsoft, at one time I owned Apple, at one time I owned Google. So they can become value companies. You got to be patient when it comes to investing, but it could happen. So don't think now, oh, it's 20% buying opportunity. Maybe not. Don't get too antsy here.
Yeah, and one thing that's really weird when I looked at some news on the company's quarter is PayPal. The CEO came out and said user growth missed the targets due in part to 4.5 million illegitimate accounts that joined the platform. If I was looking at buying this company, like, what the heck? Not only is that a problem for growth, why are there illegitimate accounts on it? That's not a good sign to me.
I repeat that number again. Was it 4.3 million?
4.5 million illegitimate accounts. I don't know the details of exactly what an illegitimate account is, but as a stockholder in a company like that, I'd be shaking a little bit, be like, illegitimate? That doesn't sound good.
That can't be good. That can't be good at all. No. So,
and then lastly, too, before we get into the numbers, I did want to say too is, I mean, you saw the 10-year note surge today above 1.9%. And I came off the back of the jobs report. Jobs report blew past our expectations, blew past the economists' expectations. I mean, when you look at that, look longer term, I'm not surprised we had a good jobs report. We know there's a lot of job openings out there. Companies are struggling to fill those jobs. And we're still about 1.7, 1.9 million below where we were in February 2020. So I continue to think we'll have a very good economy this year. I think the job market will remain very strong in 2022. And that, I think, is going to be problematic for the 10-year note as it continues to climb and impact these growth stocks this year.
And Chase, I just looked real quick at the graph, the 10-year. We've not been at that level. Closed at 1.93% was the yield. It's not been that level since 2019, so years ago.
Yeah, and we'll see how it kind of takes it. Growth stocks loved the gains when the 10-year note was falling. How is it going to be impacted with the 10-year note rising? So long story short, be careful. The jobs market looks good. The economy, I think, is still good for 2022, but that doesn't mean that these high growth stocks can perform well during a good economy, a good jobs market.
Exactly. All right, so we're gonna look at some numbers here on PayPal.
Yeah, let's take a look at the numbers here for PayPal. I'm going to go ahead and share my screen.
Righty, there we go. We got our numbers here on PayPal. So we see that they're in the credit services business. No surprise there. Not a lot of shorts on this, a 1.5%. That could change going forward as people start getting concerned about this. We'll see on that. But 82% in institutional ownership. Look at the PE ratio now, 30.3. That's well above the industry at 19.7. We do see price of sales 6.1 versus 5.5. Price to book value 12.6. Very good because the industry shows at 49.3 there. Price to cash flow 25.3 versus 16.2. So again, valuation ratios very high for PayPal. We do see a PEG ratio of 1.6. That is better than the industry at 2.7. You do want this lower, but I'm kind of curious. And I want just going forward somewhat, Chase, to see if it does increase, which is not a good thing. You want it to decrease. I have a feeling that could happen there. Look at their earnings per share growth over 1 year, 17.5%. Well, the industry is 74.5, so that's not good. I would think it being a lot higher. I'm checking. Yeah, that's up 17.5. I thought maybe it's 175, but it's not. We do see sales are up 14.5% over the last year. Industry 17.7. So very disappointed with such high valuation ratios. You're not seeing better growth rates on the earnings and on the sales. We do see the estimate from the analyst of the 5-year earnings per share growth estimate to 16.8%. Also not as good as the industry at 24.1. So these are not good numbers at all for a growth company. We see they do not pay a dividend. Look at the balance sheet here. We got a current ratio of 1.3. That is the same as the industry. Debt to equity 40% versus 130%. That is a positive. They have a lot of more room if they need to. They can borrow more money and not put themselves at risk at all. We do see they have about 13.9% of intangible assets. That's below the industry at 28.6. Makes the balance sheet much more stronger with that. We do see that you got a net profit margin of 20.1. Again, the industry at 28.8. I'm really scratching my head. The industry is much better than PayPal. Why are we paying such a high number for this? Return on equity, no change, 22.3%, below the industry at 37.9. Return on capital, 17.2 versus 24.4. So we don't look at PayPal very often. I'm very disappointed in these numbers. They should be much better.
Well, and the thing I'm interested in too here is on the balance sheet is I know they're in the credit business, but I know they have they work with Synchrony. So I don't know how them being in the financial business impacts their balance sheet. We know banks, they have very different accounting. Does it impact PayPal's accounting whatsoever? I mean, I'm not worried about their balance sheet. It looks fine, but I was actually expecting a lot different numbers when we were looking at the balance sheet for PayPal. Just something to point out. I want to know a little bit more about the insides of their business.
Jason, I want to point out when we do this, I mean, instead of being smart investing, maybe we should be the thinking investor, because what we're trying to do is point out things for you to think about and learn from. We're not going to tell you, yes, it's a great buy, a bad buy. We're trying to point in the right direction and giving you things to kind of work through so you can make the decision, is this the right company for you?
Yeah, good point. Looking here though for PayPal, their current price $126.08. You can see, gosh, 52-week high $310.16. That is a huge decline. 52-week low $123.85, right near that. Guys, you see year-to-date return down 33%, and I'm going to even look at the 1-year return now, down 50%. Not a good spot at all for PayPal. The other thing I'm going to point out is this is crazy. When you think about the valuations, this company's been cut in half and they still trade at 30 times earnings. Who in the world is buying this company when it was trading at those crazy valuations? I mean, this is what we avoid when we invest. I'm going to come back up here. You see these valuations, they're not inexpensive, and that's after a huge haircut. What were people thinking here?
And Chase, I just did the math real quick. That's a 60% decline in the stock price from the high. Gosh, there's got to be people out there like not very happy if they paid $300 a share for this stock.
I mean, yeah, 60. That means this was trading at over 60 times earnings. I mean, that's why we don't buy high valuation stocks. Again, we don't hit the home runs all the time, but we're going to avoid your PayPals where you lose 50% in a year. And even now, you might be saying, hey, this is a great buying opportunity. Well, let's take a look at the analyst expectations going forward here. I'm going to go out to December 2023. you can see estimated earnings per share of $5.91. We get a target sell price here of $98.11. So even now, with a huge decline, it's not a value company. And I always talk about this. Is this company now stuck in limbo where growth investors no longer want it, but now value investors are saying, well, it still trades at 21 times future earnings. That's not a good value. This could be a big problem for PayPal. I don't see catalysts to send this stock higher.
Yeah, I agree with you, and that's why you got to kind of watch this company. Maybe this will be a company down the road you can buy some great levels, be a fire sale and so forth. But right now, you make a good point. It's in limbo. Growth investors don't want it. Value investors don't want it because it's not cheap enough. So who's going to be buying this? Oh, maybe nobody. So not a good time.
Yeah, as we said, I'd be avoiding it. I think there's some other good opportunities out there right now.
Yeah, and again, you got to think about using your money. You want to use your money wisely, not say, well, maybe this will work. No, find something that should work.
Yeah,
So
absolutely. Well, thanks for joining us again here today on the Smart Investing Weekly Stock Analysis. Just as a reminder, the video is for informational purposes only and should not be used as investment advice. If you do want to find out more details, though, about our investment firm here, Wilsey Asset Management, be sure to visit our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Join us again next week. And again, be sure to subscribe for those future videos.